Welcome to the Mentis podcast. Today we have Ed Mathews, who is the CEO of Clark Street and the host of the Real Estate Underground podcast. And I appreciate you joining us today. Thanks for coming.
Yeah, Nick, good to see you, my friend. How are you?
Doing well. Thanks.
Good.
So we were just talking right before we jumped on here about how real estate is kind of anything but a passive investment when you get to a certain size. And, everybody out there has that, oh, maybe I should go invest in real estate bug, or a lot of people do anyhow. And can you kind of tell us about how you are spending kind of a full-time job and how that's benefited you guys right now, in today's market, especially with the dynamic, kind of field that we're on?
Yeah, as you said, this is anything but passive, right? I mean, the fact is that we not only have our marketing in-house. We obviously acquire and marshal our deals through our acquisition process. We also have property management in-house now as well. So yes, it's a full-time job. Yes, we have a team. Yes, we have business systems and enabling technologies. And no, this is not a side hustle. This is a real job, right? I mean, I'm in good weeks, I'm in the office 35 to 40 hours a week. In really busy weeks, it could be 60 to 80. And, fortunately now, when I was in corporate America, that was hard. Now because I had to go ask somebody's permission to go to, say, for instance, today, my daughter's softball game, right? Today I do not. I just let my team know, hey, I'm going to be out of the office for the next 90 minutes and find me on my cell phone if you need me, which entirely different thing, right?
That's right. Yeah. I mean, I think when people ask that question, well, how do I get started? They should think about the end. Keep starting with the end in mind. Some of those famous business books.
Without a doubt. Yeah, Covey had it right.
Yeah. Do they want to be, a full-time real estate investor, or do they want to go make their money somewhere else and keep their money invested in real estate? And that's a totally different paradigm.
It is. Yeah. There was a point where. So I'm very passionate about this. There is, very specific things that we want done in our properties to maintain the residents, relationship with the residents, and do a good job of managing our assets and all that. And the fact is that for us to scale, it required me to go full time. It just couldn't. I was a technology guy working for a handful of companies out in California in the Silicon Valley. And, it's really hard to manage that business when you start to get to, I don't know if it's a number of properties, number of doors, or, an assets under management figure, but it was right around $3.5-4 million for us that it just required, there was a no-go, right? And, it happened to coincide with the fact that I was traveling 150, 200 nights a year, and I was missing a whole bunch of really cool stuff with my kids and my wife. And I wanted them to continue to like me, and because I sure like them. And so, it kind of coincided into, okay, it's time for me to, to take this on full time and run a business as opposed to a side hustle, which is really what it was.
Sure.
When I was working in corporate America.
Certainly, you can dip your toe in and get those one or two, or even several rentals, whether it be a single family or a small multifamily, or even a small medical office, or just a small little office building or something. It doesn't matter what, you could do it, but once you kind of start getting that itch for another deal, that's anything but a passive job. And I think that's where it comes down to. You're either going to go that route, or you're going to work with people who are doing it full time, and really just work on building your relationship with that company and making sure you trust them. And that's kind of just what I would recommend. But everybody has their own way.
I totally agree. I mean, the fact is that we started this legitimately as a side hustle. It became a real business where we were pouring our money in, and now we're kind of taking it to the next level. So we're at about, a little short of $10 million under management. Now our job is to take it to 1,000 doors. And so we're taking our next step, and now have started to syndicate, and we're going to, at some point in the very near future, raise a fund and really start to grow this business and take advantage of the next layer of opportunities that are coming our way in this market.
That's right. And you had mentioned bringing people in-house. Property management is certainly one of those, kind of key pieces to this business, to making sure that at a minimum, you're trying to be able to execute your business plan as close to what you had anticipated as possible. Certainly things like COVID and inflation and eviction moratoriums are all going to throw you for a loop, but it's how you're managing those and making sure that you're dealing with it in the best way possible. People on site are by far one of the most, I would say by far the most important, or one of the most important aspects of the management side. How did you
Without a doubt.
decide to bring that in-house versus going third party, and how are you managing it and kind of being a little bit more, I guess, competitive than other folks out there?
So when this was a side hustle, I hired a local property manager, and she did a great job. And then they sold that business. The couple that owned it sold the business to another local investor, who immediately doubled the company in size. Good on him, but it made it really hard for him to track all of the properties. And so, one of the things that we pride ourselves on is, the Clark Street way, so to speak. And, that is that we have excellent relationships with our residents. When something breaks, we fix it immediately. If they have a question, they get a phone call or an answer as quickly as humanly possible. And we value, whether you're in a C-class building or an A-class building, although we don't have any, we have A's and B's. Doesn't matter to us. You're going to get the exact same customer service. And so when we went full time, we ran the business actually with that property manager, and realized that while they're good at their job, they were running it their way, not our way. And so we made the decision to move it in-house. And for us, that meant a combination of team here in Connecticut, where we're headquartered, a team in the Philippines with our virtual assistants, team in California with our platform called Hemlane, which is our property management platform, and then the local handyman, plumber, electrician, HVAC type person to help us with maintenance, turns, and whatever else happens to come up. And so we built a process and a system around managing the relationship with the residents, as well as taking really good care of the buildings. I tell people all the time, Clark Street's in the business of buying crappy apartment buildings from landlords who really aren't that good at their jobs, right? And so, our first pass is clean and safe, making sure that everything is safe. And then, we upgrade common areas, and then we upgrade units as they come open. And the idea being that, we want our residents, and along the way, we're repairing the relationship with the residents in terms of, you can count on us to do the right thing and to take good care of you, as long as you want to stay here. And, the whole idea, the reason that we're more competitive than, let's say we own a 10-unit building and next door someone else owns a 10-unit building that's nearly identical. The reason that ours is more valuable, the reason ours cash flows better, is because we're really good at retaining our really good residents. And our average resident stays a little bit more than 2x the average here in Connecticut, which helps us with having to do turns. It helps us with having to do lease ups. All of those things are expensive, and so for us to be able to defer that for 3-4 years down the pike, is that money that would have gone to a local realtor to lease up that unit, goes to us and our investors instead, right?
That's pretty powerful, the retention metric. How are you guys tracking that?
We track it from, obviously you can't track it from inherited residents, right? So we start at the day we acquire the building. And the state of Connecticut has various metrics in terms of average tenancy. I think it's like around 16 months right now. So, pretty much everybody's moving every year and a half, which is a lot. And ours is closing in on 4 years. So the whole idea is to track that on a quarterly basis. So every month after the quarter close, we track it and see how we're doing relative to the past years, and slowly but surely we're growing that number. So
That's
mission,
good.
so far so good.
Yeah, I mean, certainly resident retention is that's a really great metric, especially if you're still able to drive rent. Uh, One of the concerns some people might not think about is the banks. They sometimes want to have, especially if you're getting into larger property, they want to have a nice track record with whomever is managing it.
Yep.
And I think this is kind of probably in that like middle ground. You probably already have decent relationships with your lenders, so they're probably letting you get away with more than what maybe a new client would. But can you maybe talk about that relationship and how you guys are maintaining the goodwill of the bank? Because obviously it all comes down to making sure that the properties are performing and making sure that they're comfortable.
So we work with several local and regional banks, as well as some commercial lenders, and actually a couple of hard money lenders as well. And so we are in constant contact with them. They know, if they ask, or most of the time we're proactive, at least on an annual basis, of providing them with our financial statement so that they understand, A, we're healthy, B, we have a cash position to be able to weather pretty much any storm. And that we're well run, right? They see progress. As the balance sheet is getting larger, the liabilities are slowly going down. Equity and assets are climbing. And the reason being is that we want to make it easy on the loan committees to be able to marshal one of our deals through their process. And we just view that as part of the relationship and relationship building. We're in constant contact, when good stuff happens, when bad stuff happens, the banker is one of the people who gets a phone call. Hey, here's what happened. Here's what we're doing to manage that. And, we had a boiler go out. That's going to be a $60,000 expense that we were projecting to happen 3 years from now. And it's happening now, and that's okay. We have cash for it. And here's what we're going to do. And here's how we're going to replace those reserves. And, not to worry, we've got a handle. I'd rather do that than have someone find out, because a lot of times we'll go to the local bank. So we do business all throughout Connecticut right now. And if there's a local bank who's interested in working with property owners, I would much prefer to work with, a local bank than someone, out, in yonder that doesn't know me from Adam, and I'm just a number. Right.
No kidding. Plus, they know the market. They have a vested interest in the community. They want to see it improve. All those things are definitely a value add, and they have the flexibility. And it comes down to like that people part of the equation. And it's like if they have a good rapport, that goes a long way.
Relationships are everything in this business, right? And
absolutely,
your reputation is about the most valuable asset you're carrying around with you.
Yep.
Right. So you've got to make sure that everybody knows the value system from which you operate. And there's certain things I don't tell people, right? I mean, we're pretty tight with our numbers, so I don't share them with a lot of people, but the fact is the folks that really need to know financially how we're doing know on a quarterly basis everything's going well, or we've had a setback and here's how we're handling it.
Sure. So leading in from the lenders, where do you think interest rates are going right now? As of this recording, right at the end of May, are we done at May 2023? Are we done with rising interest? Are we going to stay? What do you think the crystal ball, the Fed here for us?
I pay very close attention to what the regional presidents say. And unfortunately, right now, it doesn't sound like there's a lot of agreement across the board. So I would suspect there's probably one more 250 bip raise somewhere in the, or 25, point uptick somewhere between now and the end of the year. But I also think that, because the fact is that the Fed apparently is watching not only interest or inflation, but also jobs, and jobs continue to grow, especially, like here in the Northeast. If you want a job, you can get a job, and you can get a very well paying job too. And I think that is true in many pockets across the country. And in order for the Fed to kind of navigate a soft landing, so to speak, they've got to slow down job growth, unfortunately.
Well, I mean,
And so,
they've said that they're going to do that. So,
yeah,
you know, robust job growth plus core inflation is the inflation that the metric that they look at. That's not
right.
getting any better. Actually, it's kind of,
It's kind
stagnant
of
a little bit. So,
right.
They,
So I think there's probably one more raise. I don't think it's going to be a huge one, but the fact is that we were talking about this offline too. And a 7, 8, 9% interest rate for me as an investor, it doesn't mean, I see a lot of folks, and I talk to a lot of folks that are keeping their powder dry and waiting for whatever's going to happen. And the fact is, historically, mortgage rates right now are spot on historical historical norms, right? 7.5%, 8% is exactly where they've been if you look at the last 50 plus years. And so there are plenty of opportunities. I think the challenge is that there's the offer price or list price is always a lagging indicator, right? And so the owners of these properties who need to move on or want to trade up or whatever they're doing, they tend to still think it's 2021. And so they're pricing accordingly. And the conversation I have, it's got to be weekly now, is look, I'll pay a 2021 price if you, as the seller, provide me 2021 terms. If you can provide me a 3% interest rate, I'll overpay for your property. But you can have one or the other. You can have price or you can have terms. You can't have both. And so there are a lot of owners who understand that and will work with us. Actually, there are not a lot of owners that understand that. But the other part of it is that the ones that do, we're able to create a deal that works for everybody, right?
yeah, I mean, it comes back to the numbers. It's not, I mean, it's not rocket science. I mean,
it's not rocket science.
Yeah,
you're right.
Not everybody has a good feel for like maybe sophisticated real estate models and IRR hurdles and like what's a cash on cash over the deal or what's the IRR. Not everybody has that expertise, but if you do, and really it's not that difficult to learn. You could just spend a couple days online and YouTube it if you needed to. But if you have those ability to go through it, it really is so simple. It's like either this is going to pencil or it's not, and if it's not, you just move on. I think that sellers are going to come to their day of.
They're starting to.
Selling.
I'm starting to see capitulation a little bit.
Yeah.
I'm seeing a whole. What I'm starting to see here in the Northeast is, one, properties are starting to lower their price. Once they accumulate days on market. The other thing I'm starting to see though is that when someone puts something under contract. And the bank, it doesn't appraise out. There's a lot of pressure on investor capital as well. So it's not like you can turn around and say, okay, this property appraised for 100 grand less than we expected. Okay, investors, we're going to all pony up, our share of 100 grand. The answers that a lot of those folks are getting is no, and those properties are falling out of contract, right? So I'm just
I think that happened a lot more, especially as interest rates were going up. And this sounds crazy, but that's like just a few months ago, like that it was like really, really hectic, like November, December, January, February. I mean, that was like, I knew a lot of people who just sat on their hands. To me, I don't know what you're seeing, but I'm seeing a little bit more of the buyer aggressiveness because they're like, I got to get a deal done, because a lot of these guys are fee driven. And the fees are not necessarily a bad thing. I know it's got a stigma or whatever, but it's how people pay their people, and they get new deals in the door, and whether it be property management fees or acquisition fees or a promote structure, doesn't matter, whatever the fees that are, but that's how you get the people to pay attention to it. And a lot of these guys have payrolls that are sitting there just chewing away at a reserve. So I'm seeing the buyers get a little bit more aggressive, and there's going to be a meeting in the minds, and I think the second half of the year could be a little better. What do you think?
I think it depends on your investor base, right? I mean, the folks that we work with, I've known them for years and years. And so they know exactly how we operate. And so if I pick up the phone and say, hey, I've got an opportunity, it's a little bit off of what we normally do. it's the return is probably in the 11-12% over the course of a 5-year hold, as opposed to 14 to 15, 16 plus, right? Is there any interest? Yeah, let's do it, because that's what's out there, right? And so
That's a
I'm
great
willing to
return.
do that.
That's a
I'll
great.
take it, right? The things I won't do though is I won't buy a 5 cap and borrow at 8%. Right. I'm not, I just,
Why not? I don't
that
know. That doesn't make any.
it
Yeah.
doesn't make any sense to me. I don't know how people do it. They do it, but
Well, typically the people I'm
real
seeing
money
do that have a major value add equation somewhere in there. If not, they're just that
and massive capital reserves. Right. Yeah. It's both. Right.
Yeah. So you brought a lot of this in-house, and you guys are all full-time now, and now you are the host of the Real Estate Underground podcast, and you've been doing that for a little while. Tell us a little bit on why you started that, and how's it going?
So quite frankly, it was a selfish reason. I love helping. So I was involved with the local Real Estate Investors Association. I was one of the partners, and we were doing coaching and mentoring, and I was throwing my arm around anybody that would listen. And I always used to say, I'm a cheap date. If you buy me a cup of coffee, I'll spend half an hour with you. I'll answer any question you have. I'll tell you everything I know about the subject, and if I don't know something, a pretty good chance I know somebody that does, and I'll hook you up, right? And in most cases, I'll buy the coffee, right? It's just something I truly enjoy doing. Primarily, there's the contribution and the juice you get from that, right? But it's also, I had half a dozen people in my life over the last 20 plus years who either saw something in me or took pity on me and threw an arm around me and helped me. And they didn't want anything. The most they got out of me, in return was scrambled eggs at breakfast, right? I mean, I was buying them one of my mentors breakfast once a month. And so, my way of repaying those people is to do it myself. I was doing it through the RIA. I made a very difficult decision to leave that RIA because I was spending so much time there. It was taking away from Clark Street, and I needed to focus on our core business. And so the Real Estate Underground podcast kind of scratches that itch for me, where we bring in really experienced real estate investors. Most of them are multifamily, but we do bring in other folks from different asset classes. The idea being that I'm gonna basically be curious and ask our guests, talk to me about their mistakes, talk to me about their wins. How did you think about that? How did you get started? Why did you focus on this asset class? And the idea being that these really accomplished, smart people will hopefully drop gold nuggets for me and the audience. And so I get to learn. I hope that the audience gets to learn. Feedback's been really good, and the audience has been growing steadily for just about a year now. Frankly, I get to talk with really impressive people who, if I didn't have a podcast, might not return my phone call. So it's actually a sneaky way to meet really, really interesting people too.
No doubt.
Yeah.
Well, you remind me of a few, lessons that, these are things that I like to incorporate into our company, and I need to get better at too. But I can think of probably the 5 people right now who I would call like the master networkers. And every single time, they're, without me going to them, they're like, hey, you need to meet this person. And they're just sending things to you like somewhat frequently. And they seem like the abundance that I know comes back to them. It's got to be in spades, if not just goodwill. But it's something I certainly need to get better at. And it's a good reminder. And the teaching is a great way to do that. But certainly the industry, I find is while you might be competitive or competitors or whatever, I find it to be quite collaborative. People are very willing to help.
It's interesting. The folks that I know in this space, both locally and across the country, the ones who are really thriving and have been thriving for a long time understand the concept of abundance. The ones who are closed and don't want to share and don't want to take the chance of giving up a missile seeker to a competitor tend to struggle. And I think that it's a big world out there. The opportunity pie is enormous, and I don't need the whole pie. I just want my little slice, right? Mm-hmm. And if you get your little slice and I get my little slice, We all win, and I'm good with that.
Yeah, people do crack me up, sometimes when they, even like the quote unquote big guys, they've got 5 billion, 10 billion under management. I'm like, they're not even a blip on some of these, massive companies. So it's all relative, and
it is.
There's plenty of room out there for literally everyone. So
indeed.
Yeah. Well, I appreciate your time today. If people want to reach out, learn about what you guys are doing at Clark Street, or potentially reach out to be a guest on your podcast, what's the best way for them to reach you?
So our website is always the best way, or social media. So we're clarkstreet.com. So clarkst.com and Clark Street Capital on all of the social media. I'm not on TikTok, but my team is trying to get me to be on TikTok. I just won't dance. Or lip sync. So I'm willing to do reels and stuff like that instead. But so you can hit me up directly. I'm Ed Mathews, or Ed Mathews 4 on pretty much every channel out there except TikTok. And then as far as the Real Estate Underground, so that's reupod.com, Real Estate Underground, reupod.com. And we've been doing it for just about a year and a half now. And I'll admit that the episodes from this year are much better than the episodes from early on, mainly because the guy that was interviewing has gotten a little bit better at what he's doing. And but it's a lot of fun. I think it's very much educationally based, and we're not selling anything. We're just trying to help advance the cause of someone who wants to listen.
That's right. Yeah, there's nothing for sale. I mean,
I don't get anything out of it. It's just fun.
That's right. Well, I appreciate you coming on. Best of luck with the rest of the year and the real estate fund that you guys are about to start. And of course, reach out if you guys need anything. And thanks again.
Without a doubt. Thanks, Nick. Good to see you.